Hi, everyone. Good
I'm a
evening.
little taller than the.
Yeah, we can
Yeah.
move the desk up. How's everyone doing tonight? Feel free to pop it in the chat. We have a presentation ready. We've been working on it all day, trying to make sure we're talking to the best experts, looking up everything, getting advice from our mentors, all of that stuff. But we really want to make this an interactive Q&A time tonight to serve everyone as well as possible. Can I get like something in the chat of like thumbs up, video working, sound working, everything going well?
Looking good.
Awesome. All right. Well, let's jump right in. You ready?
Yeah.
Okay.
Yeah.
Okay. So there we go. We are Nick and Elaine Stoggerberg of Black Swan Real Estate. This is our March 2023 Community Power Hour. This was supposed to be Passive Investing 201. So if you're here for that, great. We have something even better for you tonight. Really just honing in on what's going on in the banking system, what's going on with the Fed, the FDIC. Really feel like this was very timely, really feel like this is like a major event in our current economic cycle, which of course informs your passive investing. So if you came for that, but you're here for this, I promise you that this will be a good use of your time and will help you on your investment journey. And then we will bump Passive Investing 201 to April 2023 for our community hour then. We're so excited about those slides. We've spent a ton of time on those slides, really have a lot of great information. And that also gives you a little more time that if you weren't with us in February for Passive Investing 101, that gives you a little more time to watch that replay. So a lot going on. Let's jump in. This is our kind of impromptu state of the market. We tend to do a state of the market once per year, but we're doing one right now. We're really focusing on what's going on in the banking system, but it's impossible to talk about the banking system without talking about a more broad state of the market. We're not sharing kind of our typical things that we do in terms of like number of showings, days on market, those sorts of things that are very real estate specific. We're focusing much more on like macroeconomics, but very much a state of the market informed by what has happened with Silicon Valley Bank.
Just our usual disclaimer that we encourage you to seek advice from your professionals. This is for educational and entertainment purposes only. This is not a recommendation to execute any particular investment strategy or invest in anything specific. More than anything, we just want to equip you with some really powerful tools today. So just our usual disclaimer there.
Absolutely. Couple of announcements. So for K1s, I've got lots of emails and everything about that over the last couple of days. For all of our joint ventures and for Fund 1, either your K1s have already been sent out, or we anticipate that they will be out before the March 15th deadline. So particularly for Fund 1, I know those are going out either tomorrow or the next day. So keep an eye on your email for your K1. For Fund 2, we did need to bump to April 1st. That's largely because we closed on an asset like December 28th. So getting the cost seg study and everything that we needed to have for that delayed that a little bit, but we're committed to our April 1st deadline. For the tech fund, we don't yet have those dates because Lotus needs to deliver the K1 to us, and then we need to get that to our accounting team and then deliver our K1s out to our tech fund folks. For Fund 1, we have a really exciting announcement, particularly in the wake of all the craziness that's on every news channel and every website right now. We're doing a distribution for Fund 1 in Q2. We're just waiting on closing on the final asset that will go into Fund 1, and then we'll take a look at the liquidity and do a distribution. So please update your bank account information in InvestNext so that when we process that automatic payment, it gets into your bank account. If you have any questions about how to do that, how to log in, those sorts of things, please reach out to Rachel. She's on the call tonight. You could send her a message. Her email's right there, rachel@blackswanteam.com. She's a wizard at InvestNext and will take very good care of you. And then some of our upcoming teaching things, our single family at scale course. I wanted to call out that we do this live community hour call once a month, and we do try to handle any Q&A that comes our way, but we have a much more in-depth coaching call that we do once a month with the members of our single family at scale course. That's a give what you can model. 100% of revenue goes to charity. So it's really like our passion project, our way to serve not only you by giving you life-changing investment education and a monthly coaching call, but also to serve our charitable mission. So if you want more of this, sign up for our course, and then you get an additional once monthly coaching call. And that is structured a little bit differently than this call in that the attendance is usually smaller and we don't have any prepared remarks. We just do Q&A and coaching the entire night. Our April community hour is April 10th at 7:30 p.m. Central. That's when we'll cover Passive Investing 201. In May, we will cover investing with your spouse and communication. And then our Black Swan Real Life event is coming up September 15th through 17th here in Rochester. It was a blast last year with networking, education, property tours, time for investors to meet each other, meet their families. It was a really lovely time. I really encourage all of you to consider coming out and getting to see Rochester and meet your fellow investors. So that's in September. Those are our announcements for today.
Can't wait.
Lots of stuff going on.
So we always like to start with the end in mind. And more than anything, we want at the end of our time together tonight, you have a sense of calm, of certainty, of confidence in the actions that you need to take, and just understanding, what's going on with the SVB collapse, and what does that mean. This was an event that was entirely predictable, and Elaine and I had never predicted that this particular bank would collapse, or necessarily that any bank would collapse. But we're just going to share some patterns, some economic patterns, some patterns in human psychology that will hopefully give you a lens through which to see the entire world, to see the entire world economy or society, or however you want to think about it, and to see the seasons, the patterns in the season. And once you understand those seasons, you have remarkable clarity about where you are in the world in terms of the calendar month or year, and where you are in terms of the seasons of your own life. And ultimately, those things are what drive the actions you need to take. But we don't want to be too abstract. We want to basically tell you how we got to where we are, how bad it is, what's probably going to happen next, and how this impacts you, and what you should do, what concrete action items you should take as a result of the kind of current events that are happening in real time.
Absolutely. This isn't investment advice. This is entertainment and education. So these are the things that we're doing, and you might choose to make a decision after talking with your attorneys or advisors.
That's correct.
So some of the terms here, the Federal Reserve, also known as the Fed, that is the reserve of the central banking system of America that kind of orchestrates most of the economic activity, the economic behavior. Jerome Powell is the chairman of the Fed. So you might hear the Fed, you might hear Powell. Those are really important players in what's happening right now.
Yep. The Federal Deposit Insurance Company, or FDIC, this is the government regulatory body that's responsible for insuring banks. So banks pay insurance premiums into the FDIC. Then if a bank were to collapse, the FDIC steps in to basically insure the depository banks in that account. So as a career technologist, 15 years in enterprise software in the medical banking industry, I have probably just a little bit too much knowledge of this particular arm of the government. I personally perceive it to be perhaps one of, if not the most competent government organizations. At least the technologists that I know that work at the FDIC are exceptionally competent people working within a really competent organization. They have the ability to basically, step in. They kind of walk in the door of your bank. They shut it down from a technological perspective. They take it over in like a matter of an hour. They have access to all of your transaction information, depository information, and in a couple of days, they're able to sell that bank, create a new bank to buy those assets, whatever needs to happen. They're able to achieve pretty incredible things. They're a very operationally effective government organization, but basically their mandate is just to make sure that the banking system stays stable, and in the event of a banking collapse, people don't lose their money. Yeah.
The next is the United States Treasury, or the Treasury. This is where citizens can give money to the United States for 4 weeks, 8 weeks, 3 months, all sorts of numbers, up to 10, 30 years in either treasury bills or bonds. And it's largely thought of as the safest place in the world to place capital because it's backed by the United States. And then the last is Silicon Valley Bank, or SVB. This is the second largest bank ever to collapse in the United States, second to Washington Mutual in 2008. The scale is quite different, though. It is much smaller than Washington Mutual was. It's about $200 billion for Silicon Valley Bank. However, It's the largest banking institution in the country for technology companies. We missed a couple of words there.
These slides were prepared contemporaneously, so there might be a few
they're
incomplete
not the
sentences.
like beautiful
Yes.
grafted. These were prepared in the last few hours.
Largest banking institution in the country for venture capital in the technology field. That was where I was going with that bullet point that I apparently never completed.
And that's really important because a group of people that have common interests and common business are likely to behave similarly. And that's a critical piece of the puzzle that led to the failure of SVB.
Yes.
I project, and this isn't like anything fancy, but if they had a wide array of customers, I don't think this would have happened, because
slower moving customers.
Yeah, their customers would have behaved differently, but all of their customers were behaving largely the same way.
Yes. More than anything, this is a study in human behavior. We're not going to try to give you any kind of technical education. We just touched on some technical terms, understanding the players at hand, but that's not the most important thing we can equip you with tonight. It's understanding human behavior and how human behavior is extraordinarily predictable. And once you understand those patterns, it becomes extraordinarily easy to predict the future. For example, interest rates. They can go up. We all know that interest rates were extraordinarily low throughout all of COVID. We were kind of shouting from the rooftops in in many of the pandemic state of the market updates that we did. You really need to refi now. You really need to lock in your interest rates, because interest rates are going to go up, and they're probably going to go up faster than people expect. And yet people
get fixed rate debt.
Yes, and to get fixed rate debt.
Yes.
And we practice what we preach. We locked in hundreds of millions of dollars of fixed rate debt through the pandemic. And so we have tons of fixed rate debt going from 2.92% all the way up to 5.15. So we're looking pretty good compared to a lot of people who are at 8 and 9 and even 10% in their variable rate debt instruments right now on multifamily real estate. But humans tend to be kind of short-sighted. They tend to think about next month instead of next year or next decade. And that variable rate loan, it looked really appealing. I remember when we had the choice between getting a 2% variable or 3% fixed rate debt instrument, in 2021 and 2022. And we thought, man, it seems really appealing to get that 2%. These returns are off the charts. But our future selves are probably going to thank our present day selves for getting that fixed rate debt, because interest rates are going to go up. Like Elaine and I aren't particularly genius, market savants or anything like that. I think we just look at the charts. Yeah, we just look at the charts. We understand the patterns and we understand human behavior.
Other words you might have heard, one is exuberance. That's actually not happening right now. Exuberance happened more, think in, say, early 2021. I'm sorry, late 2021, early 2022. Mm-hmm. Sorry, as I get older, years get harder to keep track of. But if you think about when, there were just many offers, showings galore, even on, large 20, 50, $100 million multifamily communities, when there were many offers, that is a feeling of exuberance. And a lot of people entered the market for the first time during that feeling of exuberance, thinking, oh, this is so easy. Everyone's making so much profit off of real estate, not recognizing that the folks that were making a lot of profit off of real estate were likely the ones that had been in the game.
That were selling.
Exactly. For years or decades. So we love the quote, be fearful when others are greedy and greedy when others are fearful. There have been tons of great acquisition opportunities over the last several years, but it's been in pockets and largely influenced by COVID. And as COVID rates went up, kind of hysteria went up. And that's every time COVID rates went up, that's when we would acquire.
That's right.
Because the society would kind of take a big step back, take a big deep breath, and we would move in and acquire a lot. So exuberance was happening a while ago. It led to what we're experiencing now. Contagion is what the government worked really hard over the weekend to prevent happening today. So we are able to have a relatively calm webinar with you today because contagion was stopped.
Yes.
So contagion is the idea that once there's a run on the bank or some sort of mass behavior, that everyone does that, even if it has no direct impact on them, even if it's, they're completely in a different industry, different state, different bank, different economic situation, they still go and take their money out of the bank, for example. That's contagion. And human behavior can make a normal situation bad very quickly. If you think about, like, even outside of investing, something like at a concert, if there's a fire and everyone needs to exit, if everyone just exited orderly and calmly, everyone could probably get out in time. But once there's a stampede, that's when humans die, not because of the fire, but because they trample on each other. That's an example of contagion. And one thing that I always remind myself of is, especially in economics, like, all of this is fake anyway.
Mhm.
Like our money is fake. What's in the bank is fake. Paper bills are fake. Digital currency is even more fake. And so take a step back, like think from a rational place, think from a centered place, and make your decisions from that place
Mhm.
and try to stay away from contagion. If the government had not made the announcement late last night that all of the depositors at Silicon Valley Bank would be made whole today, like at that point it was tomorrow morning, if they had not made that announcement, all of the banks in the country would have had a run at
Mhm.
8 a.m. as soon as they
Yes.
opened. That's an example of contagion, and that's why the government worked so hard over the weekend to come up with a plan and to make that announcement Sunday night. And then we'll talk about our core Black Swan values, because
Yeah.
these really come from you.
We're going to dig into this here a little bit later, but all you have to think about is if you're literally being fearful when others are greedy and greedy when others are fearful. If you're doing the opposite of what the market's doing, you're going to have really good outcomes, right? So if you are a buyer when everyone else is a seller, so right now everyone is pencils down. One of the keynotes I heard at the Best Ever conference last week was you'd have to be an idiot to buy anything at any price right now. Well, I can't disagree with that statement more. Now is always a good time to buy, but now is a really good time to buy if no one else is buying. And when interest rates were super low and there was tons of exuberance in the marketplace when it was a time of harvest, it was a fantastic time to be a seller. We're going to talk about the seasons tonight. Probably should have named this talk the winter solstice. The winter solstice.
You gave away our climax
Oh,
slide.
I'm sorry.
Just playing.
Don't let
Stay
me
tuned.
don't let
Stay
me give
tuned.
away the punchline here. We'll
It's
get to
coming.
that in a moment. So, and not only countercyclical, but one step beyond that, you want to be anti-fragile. You want to
Mhm.
have an organization that thrives when there is uncertainty in the marketplace or the battlefield or whatever the place is where your organization needs to excel. This is how the U.S. military trains its troops today. It's how the most successful organizations were built from the ground up, and it's certainly how Black Swan has evolved over time. So in times of uncertainty, that's when our organization does the best. And so when we have to have ourselves, do we want to get a variable rate loan or a fixed rate loan? Well, which of those two options is going to allow us to excel in times of uncertainty? Well, that's obvious. It's the fixed rate loan. It almost doesn't matter what the numbers are because that's the ethos of our organization.
Absolutely. So let's go back. Let's rewind the clock to exactly 3 years ago, almost to the day.
How did we get here?
Yeah, so March of 2020, that's really when the economy took a big shift. So there was a nice warm up in 2017, 2018, 2019. The real estate market was strong, the markets were strong, interest rates were slowly rising, but things were like pretty calm, like very
on track.
very normal. Yeah. And then all of a sudden we had a pandemic. And this was the largest, swiftest shutdown of the world's largest economy. This had never happened before in the history of global capitalism, entirely unprecedented, and it happened overnight. If you think about, there have been plenty of pandemics in the world, but not pandemics with the internet and social media and all of the things so that this message could get out to the entire world literally in like 2 or 3 days, right? Even in 1918, the most recent pandemic.
World War II had a less severe and immediate impact on the world economy, as crazy as that sounds, because things moved slower back then.
Exactly. And then because of that, our government had a multifaceted attempt to inject as much stability and liquidity as they possibly could all at once. So kind of when I look at COVID, retrospectively, I think maybe if I was in charge, I would have only guaranteed unemployment insurance. And I would have said, anyone that's unemployed, anyone that's an entrepreneur that can submit their receipts, and anyone who is already receiving unemployment insurance, we're going to make sure that those people continue to get their paychecks, whether they're working or at home because of needing to isolate, but nothing else, none of these other things, because it seems intuitive that those other things were duplications. I understand why the government did it, because they really wanted to make sure that no one completely lost everything through COVID, and there was so much fear. So they injected liquidity in terms of PPP loans, EIDL loans, the stimulus that many of us got in the mail.
Stimulus for having babies.
Yeah,
stimulus for retaining your employees.
Yep. Paused student loans.
Mortgage forbearance.
All of the things with the eviction moratorium, like every way that they could, they injected liquidity. And a lot of that was politically motivated by both sides. This is not a political
Mhm.
statement about either party, but it's easy to give things away. It gains you political favor when you give things away. So both sides were motivated to approve these things and to approve them quickly. And what they were doing was they were solving a supply side problem with demand side tools. And that's a theme that you've heard
Mhm.
over and over from us in the probably for 3 years
Yeah.
now, right?
Yeah.
And you're going to hear again tonight. So, economics is supply and demand, but when you're solving one side with the other side, things don't always go well.
That's right. So the immediate macroeconomic response to COVID was completely predictable. The Fed slashed interest rates. You've heard us say many times before that interest rates tend to go up slowly and fall quickly and unexpectedly following Black Swan events. That's exactly what happened here. The Fed said, not only are we going to slash interest rates all the way to zero, but we're going to keep those interest rates super low for a very long time. And they initiated a kind of historically unprecedented quantitative easing program where they bought U.S. Treasuries as well as mortgage-backed securities. This is something we were kind of screaming from the rooftops back in 2020 that the Fed buying these products synthetically lowered their yield. So the more buyers there are in the marketplace for mortgage-backed securities, the lower a 30-year fixed mortgage is, and the more buyers there are in the marketplace for treasuries, the lower the interest rate is on those. And we said, watch out, be very careful. If you own these products, it's very likely that the yield on these products will go up over time. We're going to dig into why that's such a bad thing here in just a moment, and why it would be very wise for you to get fixed mortgage rate debt because a variable rate mortgage is probably going to go up quite a bit here in the near future. And these things I feel like we're very predictable. Again, I don't think we're particularly smart people. Just think about just supply and demand. When the Fed is generating $6 trillion of cash to inject into the economy, then it's going to have distorting effects on the economy. And you just have to think, well, what happens when those distorting effects go away?
Mm-hmm. And here are a name of many of the programs, not even all of the programs, but many of the programs with their dates of when they opened and when they closed, how much liquidity came in, of all the things that the government was doing to respond to COVID as quickly as possible.
I just want to check in for a second. So this is a really critical kind of technical concept we just talked about. So the Fed, created $6 trillion and used it in large part to buy treasuries and mortgage-backed securities. Does it make sense to everyone here how that would make mortgage rates go down and make treasury rates go down? And in the future, you can know with absolute certainty that those rates are going to go way up. Can I get like a thumbs up from everyone here? Does that make sense to everyone? If
Can I get an amen?
Yeah. If anyone has a question about this, because I personally perceive this to be like such an elementary thing, and yet clearly SVB did not get that memo. They didn't check out our webinar, which is this is not an I told you so. Sometimes this is just like sincere confusion as to how someone could make a $100 billion mistake that, to me anyway, seems so obvious.
Ryan and Lauren get it.
All right, we've got one person.
We miss you guys,
Yeah,
by the way. Okay. So Nick just said, there was a drastic increase in the monetary supply. So $6.4 trillion came into the monetary supply in a very short period of time. If you're able to take a look at your screen, now would be a good time. You can see that there's money coming into the monetary supply all the time. That's why there's inflation. That's a normal part of capitalism.
Grows with the economy, perfectly normal.
And then all of a sudden, it almost went straight up, and then you can see it kind of taper a little bit there. Interestingly, this was really good for real estate investors in the short term, because real estate is a hard asset backed by paper debt. So as there's more liquidity in the system, people can pay higher rents, people can pay more for buildings, which increases the value of those buildings. So in the short term, it's good to have hard assets during a time when the monetary supply is going up. So things were looking really good. And that's why there was exuberance in the real estate industry. And a lot of people came into this industry for the first time or made reckless decisions with variable rate debt.
So let's just really briefly quantify that this is such a supply side problem. China had a lockdown that is almost difficult to understand as Americans. As Americans, there's no way we could tolerate literally being locked in our homes and being policed if we came out of our homes. For a hot second there, we went from $2,000 for to get a shipping container from China to the United States to $20,000, and then now it's all the way back down under pre-pandemic levels. this is one of the largest drivers of all of inflation. So you have some raw kind of commodity input prices like oil or lumber, and then you have kind of manufactured goods or finished goods, principally the largest source of which in our economy comes from China. So when there's this massive amount of friction overhead that's injected into that supply chain, you're going to have insane constriction in supply. When everyone's sent home and told not to work for months, you're going to have insane constriction in the labor supply. 800,000 women stepped back from the labor force during COVID. My wife, being a principal example of that, and they haven't come back. There's been huge constraints throughout the supply chain and all supply throughout the global economy. And we tried to fix that by stimulating demand. So what's the inevitable impact of there being low supply and high demand? Prices go up. When there's low supply and high demand, prices go up, which is inflation. That's how inflation occurs, when there's too many dollars chasing not enough goods. This was inevitable and completely predictable. We had the highest inflation we'd seen in decades. This was particularly challenging for the middle class, seniors, people on fixed income. But ultimately, inflation was extremely good for investors who had investments in hard assets leveraged with paper debt. You've probably heard us say that phrase countless times.
I'll be honest, I wouldn't say I didn't understand it, but I reached a new level of understanding of that phrase through COVID.
Yes.
Because we hadn't experienced a lot of inflation during the time that, we were adults or we were investing. So it made sense to me. But when inflation was going crazy and our asset values were just going up every single month, that's when it really clicked, because the bank wasn't calling and saying, oh, well, now you owe an extra 100,000 or an extra million. The mortgage just stayed the same.
That's right.
It made perfect sense.
If you have gold goes up with the value of with the money supply. It's a hard asset, but you don't get super great debt on it. So when you have huge inflation, not only does your asset get more valuable, but the value of your debt goes down, is devalued. So it's kind of this double whammy that gives you these exponential returns that are really exceptional, particularly on U.S. real estate. But we're talking about the seasons here, and just like how one day you have this beautiful summer day and you wake up the next day and there's kind of that chill in the air and you feel, oh man, fall is coming. I remember when rental rates were skyrocketing and we were locking in crazy low fixed rate debt. Housing costs is the number one contributing component to CPI and core PCE. Those are the inflation metrics the Fed tracks. It's 42% of CPI. It's a massive, dwarfs everything else on the dial for the Fed. And so when we saw these housing costs going up in real time, knowing that it takes the Fed about 6 months usually to kind of get the memo and to collect all their data from a macroeconomic perspective, we knew that inflation was going up. And if you rewind the clock and go look at our talks from 2021, this is something we spoke to. So we knew interest rates were going to go up. Fall was coming and winter would be right around the corner behind that.
So we mentioned a couple of slides ago that this is all a study in human behavior. So to understand what's happening, we really think of ourselves as, we want to understand Jerome Powell as much as we possibly can. So we think of ourselves as friends of Jerome. We're like, what would he eat? What would he drink? What would he wear?
What's Jay up to these days?
Yeah, we talk about it. We'll be driving down the road and we're like, I wonder what Jerome's doing right now. What is he thinking? Because that is so important to us, because we have $1/3 billion in assets under management. We have $60 million of investor capital that we've raised. It's so important that we understand this major player kind of at the center. You can kind of think of Jerome as the quarterback of all of this. In many ways, stronger than the president of the United States. Absolutely. And so we listen to what he says and we listen to his speeches. And, it should be obvious to someone that, it's someone at his level, the next,
this statement, by the way,
I want to show this picture. So again, if you're able to see your screen, it should be evident that if this is your life. So Jerome is sitting there looking at a pamphlet. He's probably about to make a speech, and there's 1, 2, 3, 4, 5, 6 people, all with cameras, uncomfortably in his face. That he doesn't say things ad lib. That he doesn't just walk up to the podium and say what's on his mind. He prepares these remarks really carefully, because he understands that economics is a study of human behavior, and he's trying to gently guide human behavior. You might think, if you're a parent, you might not say don't touch the stove, because what's that going to do? That's going to make a kid want to touch the stove. You might say, if you touch your stove, you might end up needing a Band-Aid, or that might really hurt, because then your kid kind of knows what's coming and maybe trusts you a little more. Powell has been trying to do that to the United States of America for years now, telling us in great detail his stance on inflation. And I'm drawing a blank on the name, but even telling us, like, I am like
the Fed. Paul Volcker,
yeah, I am like Paul Volcker, the Fed chair in the 70s, who raised rates like crazy, who instigated stagflation. So he was saying something like a little controversial, because no one wants stagflation, but he was saying that to kind of up the ante of like, hey, listen, guys, like, I'm going to raise rates. I'm going to raise rates. Make no doubt about it. I'm raising rates. It's coming. It's coming. It's coming. In August of 2022, at a Federal Reserve event, he said the first lesson is that central banks can and should take responsibility for delivering low and stable inflation. And then he goes on to say other things. Feel free to read that if that's important to you.
He's not mysterious about this.
He's not.
He telegraphs it.
He telegraphs it, and he tries his best to telegraph it, weeks to months in advance. And I think to really understand the United States economy, one always has to, try to think in the mindset of whoever the Federal Reserve Chairman is at that time.
One of the funny things is the Fed always has to walk a political line, right? So you have to maybe read between the lines a little bit. Like in this last quote we had here, right in the middle, he says, it is also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply. Exactly like what we just said, that there's been this huge constraint in supply, but demand has gone up as a result of the stimulus. He says, and the Fed's tools work principally on aggregate demand. And then he says, none of this diminishes the Fed's responsibility to achieve price stability. Now, the statement, he's kind of poking fun a little bit at the government, because it used to be that Congress took a lot of action on inflation. They would say, hey, there's a supply problem. What can we do to boost supply? And the Fed would work on the demand side. And over time, the Fed Congress has kind of abdicated power. And the Fed has been like, whoa, like, this isn't all on my shoulders. You all got to do some of this job yourself. And in this statement here in August 2022, Jerome is saying, hey, it's on us, I guess. So
so here we go.
So here we go, because that means we're going to have to really, really ratchet up rates, since all we can do is demand side.
Exactly. Keep in mind, the Fed does not have a lot of tools. The Fed can't do all this various legislation.
Yeah.
Let's throw out EIDLs. Let's throw out PPPs. Let's do this. Let's do that. Let's have state level stuff, federal level stuff. The Fed has like a few tools, and the biggest one that it has by a significant margin is raising and lowering interest rates.
Yeah.
So as recently as 6 days ago, like, you might look at this article and think like, well, that was a different universe. As recently as 6 days ago.
That was Christmas. And now, wait, no, does the solstice come before or after Christmas?
The solstice comes right before Christmas.
Right before Christmas, dang it.
This was St. Nicholas Day. That's December 6th.
There you go.
So we're leading up to the winter solstice. Today, we believe, is the winter solstice. So as recently as 6 days ago, Powell was still saying, hey, next week when the Fed meets, I'm raising rates again. I've done historic, unprecedented 0.75% interest rates. I think it was 3 or 4 times. It was a lot. And then a half point after that, a quarter point after that. So things that no one had ever seen. And then he was still saying, as recently as a week ago, we're going to keep going. So he's telling the market exactly what's happening, and how many real estate investors have missed this. I'm not sure. I don't know if it's a focus on renovations or market or population or kind of
optimism,
distraction by other things, but certainly one of the main things that we think of is what is Jerome doing? Yeah. He's like a friend of ours in our heads.
now that we set the stage, let's talk a little bit about SVB.
Any questions?
Yeah.
So there's kind of a pivot now.
Yeah.
So we've covered COVID. We've kind of brought ourselves up to a week ago.
We feel like these things are really simple, and most people make these out to be really complex things. So we hope that anybody that has never heard of any of these concepts before could just go through these half dozen slides and be like, oh, okay, so whatever the Fed says is generally what happens. And there's a saying, never bet against the Fed. And that saying exists because people always bet against the Fed. And this is really simple stuff. Are people with us so far? Ryan and Lauren get it. Is everyone else doing well so far?
I don't want anyone to feel like they can't ask a question, because we've said several times this is really simple.
Yeah.
This is simple to us because we spend a lot of time doing this.
Yes.
Nick especially. I don't want to take undue credit. Nick is looking at this stuff. He probably spends 5 hours a day talking to our bankers,
That's about right.
3 hours a day working on acquisitions, and like an hour and a half a day studying the macro economy, and then the rest of the day with me and the kids. So an hour a day and an hour a day at the gym.
Somewhere in there, I think I'm leading a team, but I don't know. Hey,
That's when you're talking to the bank and all that stuff.
got it.
Any
Hey,
questions?
I do have one. Hey guys, awesome conversation so far. It's just mind blowing to me how much knowledge you guys have about this stuff. Um, I think you had mentioned something earlier about yields and bonds. I don't know if you did, maybe I misheard, but that part of the terms of the economy I don't really get. So if you could maybe clarify that, if it's appropriate and applicable to this
Yeah,
conversation.
it is 100% applicable because treasury bills and treasury bonds directly inform what happened at Silicon Valley Bank.
Yeah, so we're going to get to that here in about 5 minutes. And then
Thank you for your question.
yeah, we want
to hear from you.
Check in with you and make sure we answer your question there.
Any other questions? That was a very good one.
Yeah.
Okay.
All right.
Well, we will keep going. Feel free to put your questions in chat too. We're keeping an eye on that.
So we've set the stage from a macroeconomic perspective, just how we got to where we are today. Yeah.
So Silicon Valley Bank is about 40 years old. So not a super aged bank, but more than the last, say, 10 years or so, a nice middle-aged bank. Pre-pandemic, the bank had $20 billion in deposits. And post-pandemic, they had $200 billion in deposits.
10x in just a few years.
Just a few years. So if you think about that, if you go back to understanding the monetary supply, well, this bank just participated in that as the people who had deposits there, as they had more capital available to them through these stimulus projects, raising capital, all those things, they put it into the bank held that. And then the bank had to ask itself, well, what do we do with $200 billion? We do not need all these deposits on hand.
What if someone wrote you a check right now today for 10 times your net worth? You would think to yourself, like, yikes, this is kind of scary that all of a sudden we had all this money that we didn't even necessarily ask for. We should do something with it. Where's the safest place we could possibly put that money?
Give it to the government.
Yep.
So the safest, the two safest stores of liquidity, I mean, really ever in the history of capitalism, is the United States government and United States real estate. A bank can participate in real estate through purchasing mortgages. They're not going to purchase direct real estate because they don't want to be illiquid. So they gave money to the Treasury in the form of long-term Treasury bonds. So a Treasury bill is short-term. Shahzad, this is part of the answer to your question. A Treasury bill is short-term, say 4 weeks or 90 days. A Treasury bond is long-term, years, 10 years, 20 years, 30 years.
And it's usually perceived that a long-term bond is safer than a short-term bond because you're locking in like a fixed rate of return for a longer period of time with a longer maturity date. It's a bigger mattress to put your money in. So normally this would be an utterly safe thing to do. It's a shame SVB did not catch our webinars through the pandemic, or they would have heard, hey, the Fed is buying all of these 10-year treasuries. They're going to stop when quantitative tightening kicks in, and those rates, those yields are going to go way up. And what happens to a bond, to any bond, to a treasury bond when the rate goes up? It becomes less valuable. So think about it. Let's say I lend money to Elaine, and I'm going to say, okay, I'm going to lend you money for 10 years, and you need to pay me a 1% interest rate. Okay. Sounds good. And then a year goes by, and I say, okay, Elaine, the prevailing rate is now 4%, so I'm going to lend money to you at 4%. And then another year goes by, and I say, oh shoot, I really need cash. This IOU is not doing it for me. I'm going to sell one of those IOUs on the market, and the market has a choice between the 9-year note at 1% and the 8-year note at 1% and the 9-year note at 4%. Well, the market's going to discount the value of that IOU that's at the 1%. I'm going to say that a second time. The market is going to say that a treasury that is at a lower interest rate is worth less money than a treasury that's at a higher interest rate. So its face value is you have to pay less for it than the buyer had originally purchased. And this is the case with any asset. So it doesn't matter if you bought oil or gold or whatever it is. As interest rates go up, the value of assets goes down. And this is a huge problem for a bank where they have to, maintain a certain amount of reserves of liquidity, where if you have a $100 billion IOU from the US government and the value of that IOU goes down by 10%, well, you just lost $10 billion investing in what would otherwise be the safest asset on earth you could possibly invest in. This is a critical concept.
Yeah, follow-up question. So the 1% treasury, are you saying the market discounts the 1% treasury
Yes.
relative to the 4%, or both are discounted?
Relative, because you can go to someone else and they can pay you more money. So why would you go to the 1% person? The only way you would go to the 1% person is, and you would say, well, I'll buy that from you, but I need a steep discount because my friend over here will pay me more right now.
Yes.
Does that make sense?
So it's basically just like 4% is a better ROI than 1%. Is it really just that?
Exactly that. Exactly that.
So every time the Fed hiked rates a quarter point, Silicon Valley Bank lost $1 billion. Every time rates went up 25%, Silicon Valley Bank lost 0.25. Silicon Valley Bank lost $1 billion in the value of their treasuries.
Yep. So, and one thing I want to comment on as a physician is, if you're listening to this economic stuff and you're like, I don't know, I don't understand that, or I don't understand that yet. You don't understand it yet. You can learn these things.
This is a tricky concept here.
Even as a physician, like, I am no pandemic expert, but as soon as COVID hit the scene in late March of 2023, I just went to the internet and I just read everything I could get my hands on about pandemics in all of human history. And I tried to read as much stuff as I could so that I could get unbiased sources. And I really tried to look for things that were published right before COVID, because in that couple of weeks, again, there was hysteria, there was exuberance, like human behavior was shifting. But if someone had published something about a pandemic in, say, 2019 or 2018, they didn't know that COVID was coming. And so I was more apt to trust them. And if you look at pandemics in all of human history, they last about 2 to 3 years in all of human history, despite the increase in population, the increase in trade, the increase in travel, airline travel, all of these things that have changed over human history. Most pandemics last 2 to 3 years. And so even in early 2020, when people were thinking this would last weeks, we were like, oh no, this is going to last years. We don't presume to know how, we don't presume to know why. We are not virology experts. We are students of history. We're students of the seasons. And we just went and we looked at what other seasons have happened in human history. And they generally take about 2 to 3 years. So if Silicon Valley Bank, if they missed it on the economic side and they missed it on the tech side, if they could have talked to a health advisor, like a physician or an epidemiologist in 2021, when they were buying all these bonds, and say, hey, how long do pandemics last? And an epidemiologist might have said, I don't know, 2 to 3 years, maybe 4, but I don't know if we can hold down the human population for 4 years. So probably 2 to 3. They might have thought to themselves, okay, well, we're halfway through that. So things might be changing. We might be coming out of that and human behavior might be changing. And so I feel like there were a number of reasons that they could have seen that this was maybe, I don't want to say it was a poor decision because we're not them. We don't know them. I wonder why it was the best decision they could come up with.
Yeah. In December of 2020, if you go listen to our webinar replays, Elaine called the pandemic. So Omicron hit, and at first it looked scary because the communicability was
2021.
2021. Yes.
I was thinking there.
No. That would have been very bad.
2020 was when the vaccine came.
December 2021, Elaine called the pandemic, and we shared that with our community in real time. And the very first piece of data from Omicron looked scary, and Elaine said, but that isn't how disease works. So viruses trend towards higher communicability and lower virulency. They don't kill you, they just make you sick so that you don't die, and you can go spread the disease and it can propagate itself. The disease doesn't want to kill the host, like a high virulency disease, if I'm using the correct words here. Okay, I'm proud of myself there. That's a failed organism. It wants to just get us sick so we can spread the disease. And that means that interest rates are going to go up, and that means that asset prices are going to go down. And so we closed on the biggest deal of our entire career in December 2021. Yep.
Mhm.
And then
You're getting
we
older
didn't-
too with the years.
and then we didn't close on a single asset of size for another 9 months. For the first 3 quarters of December of 2022, we didn't close on a single asset of size, and we shared all that with our community through that whole time. Let me say it a different way. So we love the book The Alchemist. I recommend you check out the book The Alchemist. And The Alchemist would tell you that if you're searching for water in the desert, you could wander the dunes forever and die of thirst. So what you need to do is you need to look for mice, because mice have these the special sense they can find water in the desert, but humans aren't very good at finding mice. But hawks are very good at finding mice, and so you need to look for hawks. So if you're wandering the desert looking for water, as a human, you look in the sky and you look for hawks, and hawks look for mice, and you will find water. We had no idea exactly what Jerome Powell was thinking. We had no idea what all was going to happen in the global economy, but we could say with complete and utter certainty that as soon as the pandemic stopped, interest rates would go way up, way faster than anyone would normally expect, because the shutdown was so fast too. And you had better stop buying assets, and you had better refi and lock in those low interest rates, because rates were about to go way up. Now, please jump in here with any questions you have. This is a really critical thought process.
And then in January of 2022, it's so hard to remember the years, guys. I'm so sorry. Everyone got sick.
Yeah.
We had to close down
and people freaked out. People freaked out about that.
And it was so confusing to me that that's when a lot of the rental assistance programs were turning off. And I'm like, no, guys, this is the time that everyone's missing work because everyone is sick this month. And then in February of 2022, we did State of the Market, and we'll share, what we talked about there. So the bank probably would have been okay. So in the fourth quarter of 2022, so just, a few months ago, they had $91 billion of these treasury bonds on their books, and they sold 21 billion. So relative to their size, they didn't sell that much. They probably would have been okay, despite mispredicting how long the pandemic would last, despite mispredicting what Powell would do with interest rates. But then human behavior, go ahead.
And if you had some of those bonds at the 4% and some at the 1%, which ones do you sell first? You sell the ones at the 4%. And so you're actually accumulating this massive off the books debt, because if that treasury bond is allowed to mature, you can just keep it at its face value. You only have a problem when you have to do what's called mark to market, when you actually have to sell that asset and realize how much it's truly worth. So just from the couple little pieces of data here and just thinking, what would I do if I was in their spot? You can take a guess about what sort of position they're in.
Yep, absolutely. So Shazad asked, so essentially, because of increasing rates, the bank was sitting on treasuries that were worth less than what was now available on the market. That's 100% correct.
Nailed it.
Yep, you've got it.
This is the toughest concept of this whole thing, the idea that treasuries go down in value as interest rates go up. How could the safest place to park capital you could possibly imagine, how could that lose value? So again, if anyone else has some questions about this, please, there's like this is a very tricky concept, and I want to make sure everyone grasps this concept because it has huge implications.
Yep. And then someone else mentioned that if their treasuries had been held to maturity through that 10-year cycle, they would not have lost value. And that is absolutely critical. That's why they're so safe. They're backed by the United States government. The United States government says, if you give me this money for 10 years, I'll give you this thing at the end. That has always happened since the Great Depression. That is as close as you can get to a certainty in capitalism. So that's what they were banking on, was that they would hold those treasuries, that they would kind of set aside their acorns, so to speak, all those additional acorns they had gotten during the pandemic. They would set them aside and they would not need them for 10 years. And the reason they needed them is because interest rates went up. So technology companies were struggling to make payroll, manage their business, run operations. You've all seen on CNN, Wall Street Journal about tech layoffs. The tech sector has been hit particularly hard with rising interest rates. Crypto has been just completely slaughtered. So depositors came to the bank and said, hey, I need to take more money. Does that make sense? That they're running a business. So it would be like, if I went to the bank and I said, hey, I'm not having any income coming in, or I'm having less income than usual, but I still need to make payroll. So I'm taking out more money than I'm putting in. So the bank needed to get more of its liquidity back so that it could service the depositors that were asking for their withdrawals.
And that's why they probably sold their highest yield treasury bonds to suffer the smallest write-downs when they had to mark them to market. And they were slowly sitting on a problem that was getting worse and worse.
Absolutely. But they probably would have been okay if not for the bank run. So, so they sold a lot of their bonds, and of course that's reported. And then they announced that they needed to raise $2.25 billion to shore up its balance sheet, which in the grand scheme of the size of that bank, like, was really not that much. Like, we have to remember that, like, as normal people, we might hear 2 billion and think, wow, that's a lot. But in the grand scheme of the size of that bank was really not that much. They needed to raise some capital so that they could have enough liquidity so that they could service the depositors that were asking for withdrawals, just kind of keep the doors open, like do day-to-day operations. And as soon as that was announced, there was, according to Ryan Falvey, hysteria-induced bank run. So understanding a bank run is really important. A bank only holds a small amount of its deposits in liquidity, and the rest it loans out. That's how it makes money. So as deposits go up, it loans out more money, or it sells the money to the government in bills or bonds. SVB had money that they had sold to the government in bonds. So they didn't have enough liquidity, and then $42 billion of deposits came out of the bank in just a few days, in like a 3-day time period. It would be like if you and all of your friends, because again, these are all technology companies. In the beginning, I talked about how if perhaps this bank had not had such a concentrated customer network, maybe this wouldn't have happened, or at least wouldn't have happened so quickly. But it's like you and all of your best friends, and you're like, hey, did you hear about the bank? Did you hear about the bank? Let's go to the bank together. Let's take out all of our money and just move it to another bank or put it under our mattress. Like, they didn't actually have a need for the money. There was just this hysteria. That's what a bank run is. Bank runs are very, very bad in capitalism. The government and the Federal Reserve works very hard to make it that we humans don't create bank runs, because they're the most destructive thing to capitalism. A bank run happened, and that led to the collapse of the bank.
Yep.
Does that all make sense to everyone, that how a bank run can lead to the collapse of a bank? And once one bank has collapsed, unless there's a big player that comes in and says, hey, everybody, things are okay, then natural human behavior, contagion, tells all of us, well, I'm not in California, I'm not in the tech industry, I've never had any money in that bank, I haven't even heard of that bank before 3 days ago, but I'm going to go to my bank and take out all of my money too.
Investors called us and said, hey, like, are you taking your money out of the bank? And I mean, ultimately, those types of inquiries were why we're doing this presentation today. So people who are invested with us can see exactly why their money is so secure, and hopefully to share some of our lens through which we see the world to help y'all predict the future effectively.
Yep. Yeah, there's really only, I don't know, like 5 things that we keep saying like over and over and over. And it's look at patterns, look at seasons, history doesn't repeat, but it rhymes. Like, and then you layer on the economics, or you layer on the real estate, or you layer on the local market expertise. But all of that stuff is so much less important than what has history done before, and what is it likely to do again.
Ray Dalio and Jamie Dimon, when we were at the Tony Robbins Financial Summit, these people are not super geniuses. They just have created lenses or patterns or filters to see the universe, and they can see, they are thinking about, and they can see patterns bigger than the rest of us mere mortals are thinking about or can see. They're not wondering what some stock ticker looks like. They're not worried about some report on CNN. They're thinking, oh man, I just felt a little chill in the air. I think that a change in season is around the corner. And because I've seen these seasons so many times, I can predict with like relative clarity what things are going to look like. You don't know if it's going to be a severe winter or a mild winter, but
you know to go get your coat.
That's right. You know to go get your coat. Yeah.
Like, go to your coat, make the ski vacation.
That's right.
Like, these are the things that are happening. Someone asked any concern about more bank runs. So the government worked really hard over the weekend to make it so that they could make an announcement late last night. I think they made it at 7 p.m. Central, so 8 p.m. Eastern. Don't quote me on that exact time. That's when I started seeing it come through the news sources that I look at, saying, number one, that all of the depositors at Silicon Valley Bank would be made whole well beyond the FDIC limit of $250,000 per depositor, closing another bank, and then backstopping all of the banks in the country with a liquidity facility. So they did that to make it so that when the markets opened at 8 o'clock in the morning Eastern time in the United States, that there was stability. And as far as I can see, and I've checked every website I possibly can and all sorts of things like every hour so that I could give the best information that I could find today. As far as I can see, there are no additional bank runs happening. There are some investors pulling out of banks, but that's very different than the depositors pulling out of banks. So the government is working really hard to project enough certainty that the government has it, that the FDIC has it, the Fed has it, so that there aren't more bank runs.
Yep.
Very, very good question.
And they have to walk a fine line here to speak to this question, because I'm sure this is a question that's prominent on everyone's mind. Should I be like getting my money out of the bank? The Fed and FDIC, the government as a whole, in my humble opinion and in my lay opinion, they did a masterful job of managing this crisis.
I think so.
Like they absolutely nailed it. So
I do.
there had to be a pound of flesh, there had to be pain, and really the billionaires had to pay. So they let the investors in the bank get wiped out. But it would be completely unacceptable to allow those deposit holders to be wiped out, because for just one tiny little data point, in California, 0.46% of the population pays about 90% of the total tax burden in the state of California. It's exceptionally disproportional. And so I would speculate that the California state government would be unable to like make payroll in relatively short order if those deposit holders were wiped out. There'd be a chain reaction, and it would not be limited to just California. There would be a run on the banks amongst the people who had large deposit amounts that would cripple the U.S. financial system. So I think that they let things simmer just long enough that there was not an optics problem of Wall Street or Washington, D.C. is bailing out the billionaires again. And plenty of wealthy people lost money, and yet stability in the system was assured. And that this was handled so well certainly gives me a lot of confidence in the future. I think it's very unlikely. There will be more bank failures, promise you that. But it's unlikely there's going to be some sort of huge run on the bank on a national scale.
Yeah, I think so. And then also that if these depositors had not been able to get their capital, there would have been an extinction in technology that, I mean, that would have had decades long impact, right? Like Google didn't come in a day. It was a tiny company that had to grow, that then led to all of the resources that we have today. And if we had wiped all of those companies out, like, I mean, we might not like cease to exist as a country in 10 years because China would overtake us and other
firsthand,
things. So
tons of people who have deposits at SVP, and they are able to access their deposits right now, by the way. They are able to make their payroll as of right now. And when I think about those people that we know firsthand who are impacted by that, gosh, the economic devastation of those people wiped out, like they are creating so much productivity, that would be just a terrible loss to the U.S. economy.
So what you see here is that, because of the type of depositor that Silicon Valley Bank attracted, the extreme majority of their funds were uninsured. So an FDIC account is insured up to $250,000. There's some things there like, let's say a wife can have one account, a husband can have one account, a husband and wife can have one account, and those are all different accounts in the eyes of the FDIC. But for the most part, a business is going to have one account. So the extreme majority of their funds were uninsured. So when the regulators noticed the bank run, they closed the bank midday on Friday. That had never happened before. When regulators close banks, they close it at the end of business, just kind of quietly, discreetly. You can think of these regulators as like having the utmost decorum. So of course they take over the bank at 5:01 p.m. They don't want to cause panic. But this was happening so quickly because of technology, because of social media, because of social contagion that can happen in 2023 that even couldn't have happened in 2008. Like 2008 was light years away in terms of social media. So they closed the bank midday. And then they collaborated together, the FDIC, the Federal Reserve, the Biden administration, many of others trying to find a buyer for the bank, doing all sorts of things. I'm sure there were many, many conversations. I wish I could have been in that room. That just would have been so fascinating. And then they made an announcement late Sunday night. And one of our investors, aptly pointed out to me, I was really thinking of, before the US economy opened Monday morning, but they really had to make that announcement before the markets opened in Asia because of time zones. So they really were down to the wire when they said that all depositors would be made whole. And then at that time, they announced that Signature Bank, which largely was in cryptocurrency, had also folded.
Now, critically, the government didn't just save the deposit holders at SVB, because no doubt there are countless other banks that made the same error. They just didn't make it on such an exaggerated basis. So they had a flood of new money come into their depository accounts, but they probably didn't heap that into 10-year treasuries at kind of the worst time they possibly could have done it. And so the Fed had to say, how can we protect the banking system as a whole? What they did is they created a new facility that basically allows banks to defend themselves, to protect themselves from this particular type of situation happening again. And with any luck, it will protect the banking system from this exact sort of failure. But the mere fact that they've created this facility is just another way to inject certainty into the marketplace, right? So it almost doesn't matter how many banks actually take advantage of this facility.
Mm-hmm.
The mere fact that it exists is the government's way of saying, yep, the banks are going to be okay. The banking system as a whole is sound. We recognize that there is this systemic issue, and we're going to make sure that this particular issue doesn't take down, the whole banking system. And the Fed, the government, they're always asking themselves, how do we protect the entire banking system? They don't really care about particular industries, but it's critical that the banking system always stays online, because if it doesn't, that's kind of the blood of the economy, right?
Mm-hmm.
And so you can chop off a hand, but you can't chop off the circulatory system. That's when death occurs. So what does this mean? Why are we doing this kind of impromptu webinar? Why is this such a big deal? Because this issue is vast. It's not just SVB, and it's not just finance. It's you may note a few months ago we talked about when the entire UK pension fund system froze up for about a week or so, and maybe it's 2 weeks, and the UK government kind of bailed them out briefly and said, no, y'all are gonna have to figure this out. And that's because they were heavily invested in bonds leveraged by variable rate debt. So it's a double whammy. Now that everyone here hopefully has a really firm understanding of why rising interest rates lowers value of bonds, well, imagine if those bonds were then leveraged with variable rate debt, how just incredibly dangerous that would be. We mentioned how Blackstone and Starwood, their REITs, got into a very dangerous, precarious situation, and still are. They had to, kind of sell the MGM Grand as a distressed sale to generate liquidity, because they have that exact same mark-to-market problem that SVB had, where they have real estate assets that are worth less today than they were worth a year ago or 2 years ago, but they don't have to realize that loss until they run out of capital and they have to sell. So everything is fine until you have to sell. And then when you have to sell, you tend to sell your best assets first, and you kind of keep your worst assets in your back pocket, hoping no one notices just how bad things are, and hoping that things kind of stabilize and get better over time. It's this case in every industry, and it particularly impacts industries that are asset heavy. So think, let's say, oil and gas or mineral exploration, where you have huge amounts of capital you need to deploy, and these are again assets and commodities that their value goes down and interest rates go up, and then you often leverage them. Sometimes it's variable rate debt, and so the cost of that debt goes up. It's our thesis that this moment in time may mark the inflection point of our current economic cycle. So if you checked out, a couple of our past webinars, we probably said something like we're about 40% of the way through winter. And we believe that right now we're at that 50% mark. This is the official halfway point. This is just like when Washington Mutual went under in the great financial crisis. This is going to be the moment we look back in time where we say, yes, winter was absolutely here when that moment occurred. And that's critical because it helps us set our calendar. It helps us orient ourselves in time to know what's going to happen in the future. Today is the winter solstice. Hopefully that resonates with y'all. That makes sense to y'all with the two things we do on this season.
Put that in there. That was completely Nick's brainchild, and it fits so well with, when we talk about the seasons and really understanding why we completely, rewrote our webinar and everything tonight, that it's the winter solstice. Someone had a question. How is the government going to make the depositors whole? I don't quite understand this. So let's say you have a car that's worth $50,000 and it's insured by State Farm, but it's insured for $25,000. And you wreck that car, you completely total it. State Farm could give you $25,000 and say, hey, you're completely out for the other $25,000, figure it out yourself. Or they theoretically could say, you know, out of the goodness of our hearts, we're going to insure the whole thing. We'll give you a check for $50,000. Now, in that situation, that wouldn't make sense because it's just one person that's impacted. But if somehow in that story that I just made up, State Farm would lose the business of all of the cars being insured, if they didn't give all of your money, then they would be incentivized to do that. But an insurer can publicly set an insurance amount and then change it as long as they change it, you know, across the board. So they basically just said, you know, for this particular situation, we're insuring up to 100% of deposits. They have not said that they're insuring 100% of deposits across all of the banking system or anything like that. But for this particular situation, and then also for Signature Bank in New York, and then they created this liquidity facility for other banks in the country. But basically, they just decided that they were going to, that was the best decision for them to use those insurance dollars.
And from a logistics perspective, this is largely a technological solution. That's why I mentioned the technologists that work for FDIC, in my limited experience, are exceptionally competent. So they'll literally stick like a flash drive into your computers. You're as a bank, you are required to have kind of back doors into your software. As a person who wrote software for the banking industry, we were required to put back doors into our software so that the government could take over that bank in a moment's notice. And all of a sudden, the ACH requests could keep getting processed through completely different servers. So there is a huge, I know it sounds kind of crazy, but and it is kind of crazy how effective that arm of the government is, but they can step in. They could take over any bank at a moment's notice. In fact, you have to run simulations of this. I mean, so it's kind of morbid, you know, it's like running simulations of your own death or something like that. But in order to be FDIC insured, you have to maintain interoperability with their software systems so that the moment you go out of business, the moment you collapse, they can step in and make sure that the funds keep processing.
Absolutely. So how to predict the future? So I kind of actually covered this slide a few minutes ago when I said, like, there's really only a few things that we talk about over and over and over. Seasons, history repeats itself, follow human behavior, look at macroeconomic trends. So here are some of those things very tangibly. When interest rates go up, asset prices go down, and vice versa. Those things are inversely correlated. They always have been, they always will be. The Fed raises rates until something breaks. The Fed can't necessarily predict Washington Mutual is going to go down or SVB Bank is going to go down, but they try to push something, whether it's unemployment or what happened at the banks or something that when there's enough pain, then they stop. And they say that they use words like soft landing and we're going to try to cool the economy. Like they're telling you like soft landing means they are throwing you to the ground and they are trying to do it softly, but like they don't actually care if it's soft. So they wait until something breaks. Something has broken. Something huge broke on Friday when this bank collapsed. Everything is always okay until the moment it's not. The moment that someone is forced to sell, that instigates panic, hysteria, contagion, human behavior. You study human behavior, understand human behavior, understand crowd behavior, not just human behavior, but you really have to be thinking about when you're at that concert and there's a little fire on the side, it's not the fire that kills people, it's the crowd moving that they kill each other. You have to understand that. High rates are a great time to buy because typically when rates are high, asset prices are low. So you're able to lock in that low price. Right now, things are a little muddy because sellers are holding on to things. They've been so
out of desperation.
And they've also been so conditioned over the last several years that they have all of the cards in the negotiation. So I think that's why they were holding on to things until, say, 8 weeks ago. And now it's a sense of desperation because they can't cover the gap. They essentially need like a short sale.
Once the first big name syndicator did their first cash call, going back to their investors and saying, hey, we lost the 100K that you gave us a year or two ago, we need another 40K. Like within a matter of days, all of the big name syndicators have said we're suspending payments, we're doing cash calls. And when we were at Best Ever, when I was at Best Ever, everyone in there, I mean, one of the experts said for the data that he has, all these syndications have been put together in the last few years, 40% of them will be insolvent by June 1st. So it's very easy for me to look at that data pattern, and a person who's not aware of the seasons, who doesn't know these patterns in human behavior, would say, well, that's crazy because no one is selling distressed. There's no crisis, in the streets right now. But a person who's studied these seasons, understands human behavior, knows that it's going to be that way and everything's going to be just fine until it's not, and then things will change in the blink of an eye. And the first time that first distressed asset, that first panic seller hits the market, everything could change in an instant. And so you have to be prepared for that shift in perception, in kind of public hysteria, because that's probably going to be the best opportunity for you to create value in the marketplace and the best opportunity for you to buy.
Absolutely. Rates always go up slowly because they're controlled by the Fed, and the Fed has a calendar of when they meet, and they only raise rates when they meet. So rates go up slowly, even with the historic unprecedented 0.75% hikes that they did. It was either 3 or 4 times. I wish I knew right off the top of my head. That's still, rather slowly, but then they fall very quickly. Like if you think about rates were coming up in 17, 18, 19. If you look at the curve, it's just this nice, gentle up. Like back then, no one was asking us about what we thought about rising interest rates. No one cared. It was just, oh, they're just gently going up, no big deal. And then they went down in like a matter of days because of COVID. So rates go down very quickly when something happens that's unexpected in the economy. Mastering this pattern is the superpower of our model. We look at, we always say the deal plus the debt is magic. There's too much emphasis on the deal and not enough emphasis on the debt. We really think it's, it needs to be 50-50. And so we become students of understanding rates, of understanding debt. And these patterns are very, very predictable across time.
You can go back and refi an asset at a lower rate later. You cannot go back and repurchase an asset at a lower price in the future. And one comment I wanted to respond to here. So Mark said, and thank you for holding us accountable here. Sorry, there's a few comments back here. So Mark said, so often what happens is the economy is quite obvious in the rearview mirror, is also somewhat predictable looking forward, but the timing and the depth of the changes in the economy looking ahead are much harder to predict. So this is a really critical concept. One of the things that we've noticed studying from our mentors is as long as you are really careful about what you predict and how you predict it, it can be very easy to predict the future. So I could go out and say, I'm pretty sure interest rates are going to go down in the future. Well, that's not a very specific prediction. So we're not, predicting the depth, as you just said there, Mark. And yet that's still incredibly useful information, isn't it? That means we could buy an asset today that, is cash flow positive, but only barely. And I could make a very good bet with you that asset is going to have extraordinarily good cash flow here in a couple of years. And yet, if you turn back the clock to December 2021, we could have said with absolute certainty that now is not such a great time to buy, and you should be really careful about what you buy because the pandemic is coming to an end, and interest rates are going to go up, and asset prices are going to go down. So you don't necessarily have to predict the depth of things. I remember in January of 2022 on our webinar, we said the greatest risk facing the world today that's not being underwritten appropriately, so this was a month after Elaine called the pandemic, is geopolitical instability. Now, we didn't say Ukraine. I actually thought it was going to be China and Taiwan. Ukraine wasn't even on my radar. I saw a bunch of other, Middle East stuff, whatever. And yet that's exactly what happened because we are students of the seasons. And we know that people like to fight. And when COVID shut everything down, people couldn't fight for several years. And those smolders turned into blazes that were a huge threat to global stability. So, our mentors, they make predictions about the future and they are almost never wrong. It blows my mind how rarely they are wrong when we study from people like Gary Keller and Tony Robbins. And we're like, how the heck are they so accurate? But when you look at their predictions, like their predictions are actually quite basic and quite elementary. They just have a pattern for understanding the universe. And we're trying to give you this pattern today. And we sure wish SVB had the same lens for the future.
We should get SVB and Tony together.
Yeah, there you go.
All right, so what will happen next? So things will get worse before they get better. There will be a lot of uncertainty, a lot of fear, just a lot of chaos. Human behavior is going to be really unpredictable in the next several weeks. So economic January and economic February are coming. I put those in quotes because it's March and I didn't want anyone to get confused there. But if you think about like Rochester, Minnesota, like December's great, first couple snows, Christmas is great, New Year's is great, and then January and February are so dark, so cold, there's storms over and over. That's when you're wondering, like, is winter ever going to end? I can't remember what spring is like. It's so far away. Those days are coming. More turmoil in finance and other industries. But some of the good news is the end may be very near for rising interest rates. So as recently as 6 days ago, Jerome was saying that he wanted to do another interest rate hike. I personally think that's extraordinarily unlikely that he will do an interest rate hike here next week. The 5-year Treasury has already dropped over half a point from 4.3% to 3.7% as money has flocked to the 5-year Treasury.
And if you roll back the clock to, like, I think 2 webinars ago, we said at some point later this year, something will happen. We didn't say what, we just said something will happen. Something will break, because that's what the Fed does, is they raise rates until they break. And because 5-year Treasury is a forward-looking index, the 5-year Treasury will fall off a cliff. And that's exactly what happened. So with extraordinary specificity, in this case, we're able to predict the future, just knowing the patterns.
Yep. And then significant struggle is likely coming in traditional real estate syndications. So in April of 2021, we said, is now a time to buy. And we were talking about asset values going up, backed by paper debt, as inflation was going up because of COVID, as all this money was coming into the monetary supply. We were a year into COVID at this point, and the Fed was working really hard to keep interest rates low by buying mortgage-backed securities. But the moment they let off of that, you see, we were already talking about inflation. Like, we were not the first people to talk about inflation. We just read a lot and try to metabolize a lot and then bring it out to you guys in a cohesive time period.
We called every single one of our investors, every single person that had ever done business with us, and said, we need you to buy as much as you can buy. If you bought 1 property with us before, we want you to buy 2 more. We are deploying every single penny that we have. Asset prices are low. Interest rates are the lowest they've ever been. And asset prices are about to shoot way up. There's a window in time where you can do the deal of a lifetime. This is what we called people and said this.
Lots of you on this call.
Yes. And y'all did very well when you got that call. So
yeah. And then in February of 2022, about a year later, we did our next state of the market. And we said, refi now. We talked over and over and over during that time of refi, get into fixed rate, low interest rate debt, lock your rates for at least 5 years, buy now, buy as much as you could get your hands on, stay below replacement cost. That's like the number one thing. And the number 2 thing is I would say the number 1 thing is stay cash flow positive. The number 2 thing is buy below replacement cost. We kind of have those backwards on the slide there.
Yep.
And then buy things that you would be happy to own in 10 years with low fixed rate debt. And so in February of 2022, we called all of our bankers. We refied everything in our portfolio that we possibly could that had any sort of equity that we could harvest. Even if there was no equity to harvest, we moved the term of all of our debt to at least 5 years, so that we knew from 2022 to 2027, we would have this window to absorb whatever shocks came our way. And then here's a recording. Rachel can put it in the chat here. So one of the things that I love about our community hours is Nick and I have been talking about these things for years, and I want to be really careful here that this is not like an I told ya ego thing.
No, absolutely not.
This is us like honing.
Yes.
You can think of us as like.
I just realized this does seem like a big I told you so.
No. This is like we have like a radar system, and we are constantly honing that radar system. And for years, we didn't record we would just talk like we're married. So we talk like at home, in bed, doing the dishes.
We don't share 90% of those radar findings.
Right.
Yeah.
But we didn't have recordings of it. So we'd ask ourselves, like, did we talk about that? Because we're trying to hone our radar system, right? That we're trying to, sight it in, so to speak. But I looked at this today of, did we actually say that? Am I telling myself a story? Am I miscalibrating my radar system out of ego? And so I went and I looked, and at 1 hour, 19 minutes, I'm talking about refi, lock in your low rate debt. Rates are going up. Jerome is starting to signal that rates are going up. And so you can go back. It's on our YouTube channel. Rachel can put this in the chat. It's at 1 hour, 19 minutes. And then in November, so just 4 months ago, we talked about state of the market for multifamily. So
this was before I had heard of a single cash call. This is before, none of the data that's out there today was out there. But this is what we saw coming. We saw major distress for other operators that had secured variable rate debt and had recently acquired assets.
Yep. Do you want to go through what our predictions are?
Yeah. So non-recourse bridge loan providers repo assets, and we've been kind of screaming from the rooftops about these kind of predatory lenders. And we're about to see those chickens come home to roost. Unfortunately, rent growth will slow down or stop, and we're seeing those rent growth numbers actually go backwards in some of the Sunbelt markets that had huge run-ups during the peak of the pandemic. But that's going to be offset by loss to lease catching up. So even though your new leases are going out at a lower rate than like at the peak of the season, you still have leases from a while back that are below market rate and catch up, and those will offset. So overall, things are kind of okay. Low inventory, that's exactly what's happened. There's been a 95% reduction in inventory here in Q1 2023. Transaction volume slowed way down. In fact, on the single family side, it slowed down so much. Wells Fargo completely eliminated their entire home mortgage department. So that's it's not brand new news, but somewhat new news there. Incredibly low inventory at the single family side and the multifamily side. So there's no transactions happening. We don't see prices necessarily having this like epic crash because there's so much capital waiting on the sidelines. Certainly things seem pretty good in the single family side. Multifamily is yet to be seen, but we don't have a single dial on our dashboard that says there's some sort of collapse coming there. Many people in the space will exit the business. So some of these newer operators that planted in a time of harvest, they saw other people harvesting in 2020, 2021, 2022, said, I can do that. And they planted in harvest. They're going to weep in winter here, and some regions more impacted by others than others. So we're seeing that, in a really exaggerated way right now, where there's negative rent growth in the Sun Belt that had that huge rent growth run up in the pandemic. And then, northern latitudes, the latitudes that we invest in, are still seeing like relatively favorable rent growth and other, really, really positive factors from like a pricing perspective. So this wasn't that long ago, but it's enough time has gone by that we can check ourselves. And again, this is not a I told you so. This is, we really want to help you see the world the way we see the world, because when we look at Ray Dalio and Howard Marks and Warren Buffett, we try to see the filters that they are using to see the world, and they're actually really simple filters.
He wrote all of his filters in Principles.
Principles
in Work and Life. I mean, I personally have read that book probably like 5 or 6 times. Ray's pretty smart. The best thing I can do is kind of condition my brain to think the way he thinks. Right. Someone commented, I'm in 22 placements as an LP. I'm only nervous about one possibly doing a capital call. Funny thing is, I had reservations before I invested with them. Should have listened to your gut. Yes, our guts are so powerful.
Yes.
They're much more powerful than our brains. The rest have actually increased distributions in 2023. And then the comment that 40% of syndications in distress is an estimation, not actual data.
Entirely possible.
You want to talk about best ever? Because that's where you're getting this data, is being with a group of GPs and hearing what they're all talking about.
So there's 1,200 people there, all the kind of top names in the business. And they opened the conference. The sentence that opened the whole conference was, who here is scared? And then they use a phrase I don't want to repeat, that they will not survive until 2025. Who here thinks that they will be out of the business in the next year, that they'll have to forfeit their assets back to the bank? That's how they opened the conference, and then it went downhill from there. So Neil Bawa was the individual who cited that 40% number. I don't necessarily know how much I trust that exact number, but it's a number that I heard. And there wasn't a single ray of sunshine the entire conference. There was just, kind of a perpetual drumbeat of negativity. There was a talk on tactics for doing cash calls, and it's not just that one person had that particular stat. The people that I follow, or the thought leaders in the space, I guess I'm tempted to name names, but I guess that's somewhat private.
Don't do that.
So all the top names, they're doing cash calls right now. These are smart people. They would not be doing cash calls if they had cash in their operating account. They would not be doing cash calls if they saw bright sunshine and rainbows ahead. And so
they say things like, I want to be the first to do a cash call, so that when everyone else does the cash call, the investors have not run out of money. Right. So I don't get the sense that a lot of cash calls have happened yet. I think they're starting in the next few weeks. So I do think that's a distinction, that
the naive operators will be the last to do the cash calls. They're kind of holding out hope that things will get better, when they probably aren't going to get better fast enough to save them. And their failure might be relatively quiet because they got a predatory loan, and that lender is going to say, yep, we're not going to make a big deal about it. We don't even have to execute a transaction. We'll go ahead and just repossess the asset in a non-sale transaction. No one will ever have to know about this failure, and we'll call it good, because that was their business plan all along. They'll give them
that those debt funds never intended to be lenders, the way, like, if you go to the bank on the corner, your daycare's on one street and your bank is across the street, that institution is in the business of lending. A debt fund is in the business of acquiring assets via predatory lending. Does that make sense to people? Yeah. So a bank will work with people, will figure things out, will rewrite terms, help operators through, because they don't want these buildings. They are bankers. They don't want multifamily buildings. They don't want property management companies, but the debt funds want these buildings. And so the moment there's any sort of distress, any sort of breach of contract, they're just going to come right in and say, here's the contract. There's no negotiating room, no breathing room. We'll just foreclose, because that's what they wanted all along. Yep. And so it's important to know the incentives of the people that you're working with, what their ultimate mission is. And the debt funds have been dangerous all along.
Yeah, we've been screaming that for years. Hannah said, is bad loan the only reason things are so bad, negative in multifamily?
I would say for the most part. I mean, rents are still strong. Occupancy is still very strong, but the variable
caps are a huge part of that calculus as well. So, so a lot of people, they would get a variable rate loan, and then they would purchase an interest rate cap on top of that. So an interest rate cap is an insurance policy that limits the how high the rate can go, and you have a contractual obligation to put new money into an escrow every month. With every contract, every loan is different, but the most common arrangement is every month you have to put money into an escrow to buy that new insurance premium, just like an insurance premium on your personal home, where you buy it once a year, but you have to put money in every month. And it's very expensive to insure a house that's actively burning to the ground. And likewise, it's very expensive to buy an interest rate cap insurance policy when you've already blown out the upper end of any number that original cap was originally intended to meet. So it's, in some cases, you've gone from putting $1,000 per month in escrow to $100,000 per month into escrow. So it's not just that you've now hit your max variable rate on your loan, it's that you're paying in a completely unmeetable amount of money. And if you got one of these non-recourse Wall Street bridge loan products, again, it's a trap. So they put your money into a lockbox. They say, okay, before you're allowed to pay the electricity bill for your property, you have to pay into your interest rate cap escrow policy or other lending costs. And that's on purpose to strangle you so that you're encouraged to surrender the asset. So when you have one of these loan products, you don't even have access to your own bank account. The lender owns the bank account, and they have the right to put your money in a lockbox and to lock you out of your own rent deposits from your asset. I know that sounds crazy. That's how they were architected. They threw such aggressive loan terms at people to encourage them to, they're just like ninja loans in 08. And I would contrast that with the lenders that we work with, where we have the bank account, we have full control of the bank account. The bank has no right to touch that bank account. Sometimes they'll try to negotiate in the right to do so, and we say, nope, sorry, that's a deal breaker for us.
We almost always have, if we own like ABC Apartments, the debt for ABC Apartments is at Main Street Bank, and the bank account for ABC Apartments is at Center Street Bank. We almost always try to negotiate that.
So there are multiple factors here that exacerbate this problem synthetically, deliberately, in my opinion, to make this problem as bad as it is. So hopefully that answers your question there.
Okay, so let's talk about what we're doing with Black Swan. So a lot of you on the call are our investors in Fund 1, Fund 2, the tech fund. So the tech fund is obviously the one we sent out a notice on Friday, specifically about Silicon Valley Bank, because technology is so close to Silicon Valley Bank. So the technology fund itself had no deposits at Silicon Valley Bank. We learned today that one of our many portfolio companies had one bank account at Silicon Valley Bank for about $400,000, so about $150,000 over the uninsured amount, which has now been insured. But if it hadn't been insured, the loss would have been a total of $150,000 against a $150 million fund. What's really important to note about the technology fund is Lotus has made the decision to not have any debt on the technology companies. So we have a lot of debt in real estate, but we have fixed rate debt, long-term fixed rate debt. In technology, debt is much riskier. And so if you can kind of think about like the analogous amount of conservatism we have in the real estate world, we have a similar amount in the technology world. It just has to manifest itself differently because it's a different industry. So because we have no debt, on Friday, there was a lot of confusion or wonder of, well, if I don't have access to my capital and my line of credit gets frozen and my loan gets frozen, like I don't know how I'll continue to run my operations. But not only did we not have any capital there, but we also didn't have any debt. So we're not waiting on, oh, well, we need to have access to that line of credit, or this thing has to happen, or we have to service this debt. So those are all of the ways that the technology fund, it's structured differently than the real estate fund. We behave differently because the sector is different, but the mindset behind the technology fund is similar. If you kind of think of like a scale from risky to conservative, we're kind of at like that same point in the technology fund and the real estate funds.
Yep.
So I'll let you speak to Black Swan Real Estate while I take a break.
We're hyper conservative. To a certain extent, we have like our no fees model just from a position of principle, and we really like that structure. But at the end of the day, it's also a very conservative position to have. Like, no money kind of comes off the table, so to speak, on the front end of the deal, which doesn't just align our incentives by keeping it out of our pocket on the front of the deal, but it keeps the money in the deal. So our deals are extraordinarily well capitalized. And the fact that we have 100% of profit going to investors until they get a full return of capital means that investors are able to get their money out of our deal faster than they could mathematically do it with any other structure, with no fees and them getting 100% out of the deal. To a limited extent, once the LP's money is out of the deal, even if the deal collapsed, like your exposure has been minimized or eliminated depending on
You'd
how
have
you
like a
think about
loss
it.
of time,
Exactly.
like an opportunity cost,
Right.
but like no actual dollars lost.
Right.
Yeah.
So it's also critical to note that not a single penny of variable rate debt has been deployed to any asset in our portfolio, which over 90%, or I hear different estimates on this, but I estimate about 90% of all of the multifamily deals done in the country that I have knowledge of anyway during the pandemic era were done with variable rate debt. It was extraordinarily uncommon to use fixed rate debt, and people kind of looked at you as naive for getting fixed rate debt, because we had a choice. We get 3% fixed or 2% variable. Well, your returns are off the charts with that 2% variable, and the logic was, okay, well, let's say rates go from 2 to 4%. I still come out ahead on average, versus your 3% fixed, and I get to front load that. So with time value of money, because the rates will go up slowly, with time value of money, I'll come out ahead. And then I'll buy a cap, an insurance policy that says if it goes above 4%, then I'm covered. And that's super cheap to get that insurance policy. But no one ever stopped to think, well, what if rates go to 5 or 6 or 7? That just was not on anybody's pro forma. And so it's extraordinarily unlikely that that we would have gotten this much fixed rate debt unless that was something that was just philosophically important to us. That was part of our ethos as an anti-fragile company, a company that leans into Black Swan theory. Our highest fixed rate debt's only 5.15%, and our debt goes all the way down to 2.92%. We have some extraordinarily low fixed rate debt, and we have a huge amount of seller carry debt at 0% with no interest, no payments. So we just have so much margin to work with on these deals, and we get to enjoy all the benefits of the rent growth we've seen in the market without the downsides associated with that variable rate debt. And most critically, we're long-term hold people. So when you have a short-term plan where you need to get out and get in and get out quickly, it could conceivably make sense for you to like plant in summer and hope you can harvest quickly before winter comes. But when you are a perennial and not an annual, when your goal is to survive many, many winters, you just have a radically different mindset that's ultimately, it is a fundamentally more conservative, more secure approach when you're focused on the long term.
Absolutely. So that leads to, we've shared this slide many times before. This was in our Fund 1 launch webinar, our Fund 2 launch webinar. So what does Warren say? So Warren says, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. So an infinite hold period or indefinite hold period allows for an infinite rate of return once a cash out refi is exercised. It aligns interests with the deep value add of, we really think of, if we're going to pour so much blood, sweat, and tears into these renovations, like that's the worst time that we could give that thing away. We want to benefit from the high quality materials and the high quality workmanship that we put in, and the deep value add. So not just painting and carpet, but roofs and windows and HVAC system and stone countertops and LVP, all of those things. We really think it aligns interests with residents. That I imagine it must be challenging to live in a community where every 2 to 3 years, all of your property management is changing, the rules, the culture, versus having a culture in that community, for decades. It aligns interests with the community that, I think we do renovations that may seem silly if someone was only going to hold something for say 2, 3, 5 years, like we put all new roofs on Douglas Trail. Well, we intend to hold Douglas Trail for 20 to 25 years. So we can kind of check that roof box, like it's done. We will worry about it like a few months before we sell. We'll put brand new roofs on, and then we'll be able to say this beautiful thing has brand new roofs. So I think it's good for the community when people have that ownership mentality of assets for the long term. Huge financial advantages to be able to take one bucket of money and spend it over and over again. Certainly, we say time and time again, this is the basis of all of the wealth that we have created. Every single deal we've ever done has been a BRRRR business model. We've never sold anything. And it's easy to scale if you take one bucket and you use it over and over and over. And then huge tax advantages. So there's no depreciation recapture until a time of sale. So you're able to kick that tax can, decades down the road instead of just years down the road. So we love indefinite hold.
So we've talked about how we got to where we are from like a greater economic perspective. And then in the case of SVB, this winter solstice event, this event that's marking the winter solstice, we've hopefully helped you understand where things are going to go next and equipped you with a lens to hopefully see with crystal clarity where things are going to go. Like, the era of rising rates is probably coming to an end, because that's how that season works. And we can have some really good.
Here, Mark, listen, I'm going to go really deep with my prediction.
Oh, snap. Where are we going?
Jerome will not raise rates next week or the time after. The time after that, I can't predict. But then they will go back up for a little bit because he's got to control inflation. So he has to be sensitive to what just happened. He has to, like, the ball just like bounced, and he has to like let it.
Unless there's another Black Swan event, unless something else fails somewhere.
That's my prediction tonight.
Yeah.
Right. Like, I don't think another bank is going to fail. I think they've stabilized things.
No, I don't think another bank will fail.
And I think he'll further stabilize
but
things.
Something else will fail
next week. No, I think he'll further stabilize things next week when he doesn't do a rate increase. And then he'll keep that stability. Mark said, put your nickel down. A dime, Mark, a dime. But then the third time he'll raise again.
I could see that.
Rachel, are you writing this down? I guess it's on video.
Yeah. So we've given you all this context now. Our final deliverable here is to equip you with some like very concrete action items of, what steps can you take to prepare yourself for the coming season. So it is the winter solstice. If you're a farmer, now's the time when you should be enjoying time with your friends, skiing and snowboarding, but also tuning up your tractor and getting ready, because spring is going to be just around the corner. Did we want to skip our?
Oh, I'm sorry.
Yeah. So here's some things that we're up to that you might want to consider doing as well.
This is not advice.
This is not advice.
This is what we're doing.
This is not
and
advice.
what we're doing with a lot of your money,
That's
people
right.
who are listening.
Yeah. So we're going to remain patient and disciplined students of the seasons. We've talked a lot about the seasons. I hope that it can give you a tremendous amount of peace and calm when you think about the seasons. Like when there's a big blizzard in winter, it's not scary, not as a Minnesotan anyway, maybe if you're in California or something like that, because you know what? It snows all the time in winter, and that's just a normal thing to happen. It's predictable. It's not scary. You can be ready for it. A bank just collapsed. Big shocker. Second biggest bank collapse in U.S. history. These are not surprising. These are entirely predictable events. There are going to be some more dominoes to fall. And overall, it's probably going to be okay. And spring is going to be just around the corner. So we're enjoying the fixed rate debt that we took out in the past. We're skiing and snowboarding and just enjoying the benefits of that. And we're planning to refi after the next disruptive Black Swan event. So we're having lunches with these bankers and saying, hey, so at some point in the future, interest rates are going to go down. What does that look like? We just toured one of our assets that with a banker that might be eligible for a cash out refi soon. And we want
touring one on Thursday.
And we're touring another one on Thursday. And we want them to already have those financials in place, like in their hand. And we want them to have a mental image in their head of how beautiful those assets looked after we renovated. Now's not such a great time to refi with interest rates being at an all-time high, or not all-time high, but being at a relative high.
Yeah. They're definitely not an all-time high. Watch what you say.
No, we got a long ways to go to get there. But at some point soon, they might be much lower, and all of a sudden that cash out refi will look much more tantalizing. And heck, that banker might even call us and say, "Gosh, Nick, times are looking kind of scary out there. We'd love to put some money to work in a really safe place, and we think that's in a Black Swan asset. Would you like to do your cash out refi right now?" We're preparing for opportunities to come. So just before I got on the plane for Best Ever, we were touring an asset that we're writing an offer on. We just submitted another offer on an asset in Tacoma.
Mhm.
We're writing offers, and we're one of the few buyers that are in the marketplace right now, because we think that now is always a good time to buy. We're marshaling massive liquidity to be as prepared for a downturn event right now, because we still have to go through January and February. The worst is yet to come, but to be prepared when spring arrives. Concretely, we keep you that money in 4-week T-bills. So we have a friend on the call actually right now that helped us with that strategy several months ago. I don't want to walk you through that in this webinar, but it's a very easy process. So if you are worried about having money, over FDIC limits, we have about, $20 million in cash, and we are very mindful of where that cash sits. So it generates yield, and it's in, an extraordinarily safe place. So we have our money in short-term treasuries and T-bills, not in long-term treasuries that are susceptible to valuation fluctuations. So we can get that money back very quickly for a closing. And we perceive that to be the safest mattress you can put money.
We also have our money across like over 20 banks.
Yes.
Like
Yep.
I spend a ton of time with our accountants, like
Which might sound bonkers. But
literally
that's the mathematical truth. It's
literally
20
just
banks.
managing passwords, and you know how there's like the second factor authentication with the text message. I mean, we spend
Some of them have
probably
little generators they give us.
spend 6 hours a week just managing passwords for
Yeah.
banks. It's crazy.
Yeah. Closely monitoring our lines of credit. We love lines of credit, and that's something you've heard us say in past webinars. If things got bad enough, those lines of credit could be frozen. So that's something we're very mindful of. Right now, we feel really good about where our lines of credit are, but we might want to draw down those lines of credit if we anticipate a cold snap coming in January or February. And we want to be mindful of obtaining additional lines of credit. And as I said, we're shopping because now is always a good time to buy.
Never pencils down.
We're never pencils down.
So some action items. So above all, stay calm. Above all, remember that everything that we've talked about, it might be called economics, but it's really a study of human behavior. You can't, I missed a word there. You can't control the events, but you can control your behavior. You can control how you respond to what you're seeing in the external world. This is not advice, but some things that we might tell ourselves would be that you can hold $250,000 per FDIC insured account. If you're just holding your family's liquidity, something like a wife can have one account, a husband can have another account, the husband and wife together can have an account. Those are 3 separate accounts. Talk to your bankers, make sure they set it up in a way that those are, separate FDIC accounts. If you can, have your money across several banks. There are things called sweep accounts. So if you're over the $250,000 amount, but you don't want to have multiple banks, the bank can take care of it for you, where they sweep the money out of your account every night, spread it out to many participating banks, and then sweep it back in the morning. And that gets your money overnight into several FDIC insured accounts. The way banks close, like when banks are taken over by the FDIC, it usually happens like right at bank closure. So I'm not exactly sure how those would be safe, but that has traditionally been an option that's been available to people.
Government institutions like municipalities and stuff park a lot of their money, which tells me it's probably extraordinarily safe.
Yeah.
But yeah, T-bills are probably safer.
Yep. Multiple banks if needed. 4-week T-bills. So at any given time, if you have 4-week T-bills at any given time, you can have 25% of your liquidity coming back to you.
So every week we put 25% of our $20 million into a 4-week T-bill. Every week we put 25%. So we put $5 million into a 4-week T-bill every week. So we're never more than a few days away from getting access to 25% of our liquidity, or at most, 6 or 7 days away from having access to 25% of our liquidity. It's a little bit complicated, but when you have, a bunch of money floating around, you want to be mindful of how you're managing that.
And then, we're talking a lot about liquidity, but real estate remains, one of the safest stores of wealth, particularly U.S. real estate. So obviously we're very real estate heavy.
And you never have a problem until you have to sell.
That's right. That is the end of our presentation. There was a really good question.
Yeah, lots of good questions tonight.
Backing up a little bit. Thoughts on holding 10 to 20% of net worth in cash in 2023. Inflation is approximately 10%, but being able to have that cash to acquire a distressed asset, is that too much to hold in cash? What are our thoughts?
So this is not financial advice. I would say it depends a little bit on what your net worth total is. Are you worried about going over FDIC limits and that sort of thing? I'm guessing it's a significant amount of money if you're looking at acquiring distressed assets. I think that so 4-week T-bills, right this second are giving us like a 4.7% yield. So it's actually really high yield for a cash equivalent. So right this second, that's what we're doing is we're,
I think of our T-bills as cash.
yeah,
I know that it's not like really true, but that's how I think of
they're
them.
cash equivalent. They're
Yeah,
absolutely a cash.
yeah. When I think about our personal wealth outside of Black Swan, our personal wealth, if I'm seeing our balance sheet in my head correctly, I think we have almost exactly 10% of our wealth in actual cash.
That sounds about right.
So
yeah, that
a
sounds
good
about
number.
right. Yeah, we keep we are always super cash heavy.
That allows me to sleep well at night. Nick hates it.
Well, so it's a meta pattern that we've observed amongst extraordinarily successful people. Doesn't matter what they do, but they found a trick. They can do something in capitalism that creates massive value. They fill a gap in the market, and that trick requires a staggering amount of cash. So maybe they trade commodities, or maybe they buy distressed stocks or something like that when there's an opportune time to do so. Maybe they make a product, they manufacture something, and it requires a huge amount of float to buy your raw materials and then to sell your finished product. And they have a strategy for buffering that cash that gives them a huge advantage over their competition that is kind of undercapitalized or keeps less cash on hand. Like we have a friend that is they're one of the largest private home builders in Nashville. So they build, I mean, they have many tens of millions of dollars of houses that are just sitting there. They're not selling right now. That's how it is. And they have no hurry to discount those homes, which would kind of erode their brand value and make angry the seller, the buyers that they'd already sold homes to recently. So they can just sit on them because they have massive amounts of cash, and they would not be able to. That's a very future time oriented thing, right? People remember, oh, that's a seller that slashed prices and kind of burned me as a buyer when times were tough. People remember when you stick to your guns when times are tough, but these are luxuries you can only afford when you have tremendous amounts of cash. So Elaine and I are always super cash heavy. You get to play the game as long as you don't run out of cash. Doesn't matter what your net worth looks like. Doesn't matter if you're profitable, unprofitable. You just have to have cash.
Yep. Good question. Nancy asked, outside of real estate, are there other hard assets you'd recommend to hold or invest funds into and not hold cash savings accounts? So there's cash equivalents, there's T-bills, gold.
Yep. So we spoke to this a little bit in our Passive Investing 101 webinar. Precious metals are a decent thing to invest in. Anything where you have any kind of unfair advantage. So I'm not telling anybody here to go buy art, but man, if you were like an art curator as your day job and you had insane inside knowledge about art, then that would probably be a pretty good hard asset to invest in. If you ran a pork belly farm or something like that, I'm probably using the wrong word there.
Jared's on the call.
Oh yeah, there you go.
He would know corn or soy
butter or something like that, right?
That you sent us was amazing, by the way.
His family owns silos, and they use the silos to essentially arbitrage the grain market. So when other people have to sell their crops, so the crops are more valuable, off cycle, when it's harvest time.
Counter-cyclical.
Yeah, they're counter-cyclical. So Jared literally does that, and they have money in the hard asset of a silo that generates a profit that's vertically integrated with their own business because they can store their own crops in those silos. That's the perfect example of a hard asset to invest in. So I know we've maybe not directly answered your question, Nancy, and I'm trying to think about something that you would have like an unfair advantage in. I guess you could invest in like the building your medical practice is located in. Well, that's real estate.
Real estate.
Gold. Yeah.
I mean, gold's a big one right now.
Yeah.
Good
Next
question. And thank you for your donation to the foundation. I just saw that when I logged in today, and
lots of good is being done.
It brought tears to my eyes. You know what I mean.
Yes.
Thank you.
I don't know what she means yet, but I'm looking forward to that.
Nancy knows.
Yeah. Anna said, Philadelphia suburbs are extremely low inventory. Homes are disappearing in a few days. Bidding wars continue. Deals over asking. Anyone seeing the same in other regions? So Anna, you have the good fortune to be located in a northern latitude, a similar latitude to us, and all the northern latitudes are experiencing those market conditions right now. So down in the Sun Belt, things are picking up, but prices are still off 10, in some cases 15% from kind of their frenzied peak in the past. In our market, so we looked at a deal today. So we have not bought a single family deal in several months, which is crazy for us.
That has never happened.
We looked at a deal today. It was listed for $250. There was an offer for so it was listed for $250. There was an offer for $250, all cash, no contingencies, sight unseen last week, and the seller turned it down. When we reached out to them today, They had 6 offers in their first few hours on market. I suspect that thing might go for like 285. So it's going to go way over asking first day on market. And we haven't even hit match day. So we're still 4 days away from match day. So the market
And we're a
has,
hospital-based economy
Yeah.
because of Mayo Clinic.
so the market has not yet begun to heat up here. So and then again, if you turn back the clock, when it was kind of doom and gloom in the single family market, we've been saying every single month, like, we don't have a dial on our dashboard right now that says there's any kind of collapse coming in the single family space. There was a seasonal downturn when the weather turned cold and rates went up, but there's just nothing to buy out there. There's no inventory, so there's no reason for prices to go down, and that's exactly what we're seeing here. So right this second, prices are high and interest rates are high, so the numbers don't work super well in single family anywhere in the country. And at some point in the not so distant future, the numbers will almost certainly work better. So that's just the kind of temporary macroeconomic trend we're observing there. And Anna, you're not alone. We're seeing tremendous strength in the single family space in all the northern latitudes, but really all over the country.
We wish there was a bit of a softening.
Yeah, that would be nice.
Yeah. Phoenix has had a lot of growth in terms of their inventory, and looking at real estate data in January of 2023, median home price in Phoenix had dropped by 6.1% from January 2022 to January 2023. So where markets have had a lot of exuberance, there has been more of a contraction. There wasn't nearly as much of an exuberance in kind of the northern latitudes.
Yep.
Any other questions?
Yeah, lots of great questions here. Shazad had a question: how could have SVB handled the call for capital more tactfully so that a bank run could be avoided? I don't know. I think actually someone said in chat earlier, kind of answered that question. I'm sure there was probably a more tactful way for them to do that cash call, essentially to say we need to raise additional capital to protect our balance sheet. And as Elena said multiple times, their investor base is uniquely fast and cohesively acting. So if they had like farmers as their primary client base, I don't think $42 billion would have fled the bank in a few days. That's just not how farmers work. It's just not their psychology. They're very long-term oriented. I think that if it was possible to predict that outcome, they maybe would have, tried to raise that capital in a maybe a little bit more tactful way. Or I'm not sure what the right word is, but I don't know.
When I kind of put myself into their mindset, I think they thought it wasn't that big of a deal.
I think that's entirely possible.
$2 billion against a $200 billion bank.
Yeah. It's laughable. Almost.
Like the PR world would say, if you have bad news, release it like late on Friday afternoon. Because the banks would have been closed, so they could have released that at like 3 or 4 p.m. on Friday, and then had the weekend to find that borrower of those funds. But yeah, I don't know how else they could have handled it better.
Yeah.
I think there was just a lot of hysteria.
Yeah.
Because of their particular banking client.
Yeah, I mean, everything is very sensitive right now, right? Just as we said, in the multifamily space, for example, we know that there's not any distressed sales that are happening right now. There's almost no distressed sales that are happening that I see in any market that I track. But in a heartbeat, all that could change because that's just where the psychology of the market is right now. So we're prepared for that. Maybe that day doesn't come. I mean, the fact is that the finance industry was the first thing to break and not the real estate industry is actually really good news for the real estate industry. So in 2008, there was this weird combination of the real estate industry and the finance industry breaking kind of together. It was devastating for the real estate industry. And let's say Jerome Powell cuts interest rates even, knocks a quarter point off the rate or something like that to make a statement. That would be a really powerful stabilizing force for the real estate industry right now. Now Jerome wouldn't be doing it for the real estate industry, doing it for the banking industry to eliminate these problems where people are underwater on treasury bonds, but it would have a very accretive effect to the real estate industry. So that's one way to think about it. You don't have to be faster than the bear. You just have to be faster than the slowest person running from the bear, right? And in this case,
Park says
SVB,
that's not true.
Okay, well, it logically makes sense. So in this case, you're faster than SVB, and Elaine and I, Black Swan, we're not without risk, but I can say with pretty objective evidence that we are less risky than 90 to 95% of the other operations that we've observed out there. So it's very unlikely 90 to 95% of our industry will go bankrupt before some sort of monetary easing policy happened. So we can know with extraordinary certainty that we're going to be just fine.
I think that's a good way of summarizing it.
Yeah.
I noticed one of your slides said to sell when rates are low, but in February 2022, you recommended to buy. Am I missing something? I understand refi, but not the buy. Can you
We'll
explain?
never tell you to sell. That's never been on our
Yeah.
side.
So part of it is that we're buyers.
Yeah.
Part of it is that we believe in never being pencils down.
Mhm.
We don't comment on what price you should pay, right? Your price should always be changing based on
Mhm.
what's happening in that particular quarter. But we are in a growth phase of our wealth and we are growing our investors' capital. So that's a part of it. A big part of it too is inventory.
Mhm.
So take a step back from rates and go to just supply and demand, economics 101. So there's not enough supply of housing, either multifamily or single family, really in the entire United States. Obviously, that varies from region to region, city to city, but it's true that it's a global statement that we are behind significantly on inventory because so many home builders fled the market in 2008. They went and became teachers or police officers or opened a artist business or whatever. They didn't come back to the home building trades in, say, 2010, 2012, when things had settled down. So we lost like a whole generation of productivity from those builders. And we built fewer homes in the 2010s than any decade before, going all the way back to World War II, despite the fact that our population is so large. So rates were low in 2022. Our biggest strategy was to refi assets that we already held, but still buying, recognizing that whenever there's low supply but high demand, the price is likely to go up in the future. And if you can lock in a favorable purchase price, and then particularly our model is to buy things that are incredibly distressed so that we have a clear path to raising the asset value, so that even if we intend to raise the asset value to here, but the market shifts and then we can only get the asset value to here, well, that's okay. We still have that gap between my hands. So part of it is understanding the holistic business model, understanding supply and demand, understanding that, let's say if it was a single family home, you might offer a different amount, or you might have different terms or different things that you put into your offer, or multifamily, you might have different things that you negotiate. But we're always buying. It's just a matter of how we're buying. So good question there.
Yeah.
Anything else you would want to add?
I think you nailed it there.
Okay.
Yeah, we're never going to recommend that you sell, but now is a good time to buy, and then a good time to refi when rates are very low.
Yep.
Yeah.
Here's a really good question. Has your strategy of using high levels of leverage changed at all with current market conditions? That's a good question. We have a lot of slides on that for Passive Investing 201. So in general, for those that don't know this about our company, we generally try to stay at about 80% LTV, which in our minds is a very normal number. When we talk to our local regional bankers, 75, but really 80% is the number that we're shooting for.
And we often get up to like 90% with seller carry, contract for deed, or other kind of creative
construction,
processes.
and we're putting in the land, those sorts of things.
Yep.
At any given time, we look at our actual LTV probably about once a quarter. And at any given time, we're probably closer to like 65 or 67% because various assets are in various stages of the forced appreciation renovation cycle and the cash out refi strategy. So although I wish I could snap my fingers and have everything at 80%, and I believe that to be safe, and we'll talk about that here in a second, really it's more like 65, 67, 70 because of where things are in the cycle. We tried as hard as we possibly could in February of 2022 to get to that actual 80%. I mean, we were very transparent with our bankers. Like, we are refining everything we own. If there's no equity to pull out, we at least want to extend the term on the debt. A big part of that is it has to be fixed rate. So there's no bumps that are coming because we know exactly what our debt will be, and it has to cash flow, and it has to cash flow well. So we don't want to get to where something is cash flow neutral. I mean, our bankers won't even let us because the debt service cover ratio has to be at least 1.2. So it has to cash flow with a nice margin of error so that if something were to happen, maintenance costs were to go up, a catastrophic event, rents were to come down, we can still service the debt. We still have that buffer, and our debt is fixed for several years. So all of those things combined make us very comfortable with the debt level that we have. And then, we're going to talk about it next month, so don't go too much into it, but talk about like our belief about low leverage.
Yeah. So I want to be really careful in what I say here. The fact of the matter is every general partner is going to get as much leverage as they can get. And there's a lot of things that we observe a lot of general partners do in our industry. And then they have found kind of clever messaging around that to make it sound like it's a good thing, even though it's a bad thing. So for example, we wrote an offer a few months ago on an asset. Asking price was $51 million. And the initial LTV for a fixed rate loan on that came back at 37%. Now that's not the down payment 37%. No, the maximum loan proceeds was 37. And we ended up offering 41 million on that, which still would have left us at a relatively low LTV. But the fact is just the asset was extraordinarily expensive. It was extraordinarily expensive. And your lender, the lender in the deal probably knows way more about the deal than you as a limited partner would ever know, because they have very intimate access to the partners involved, the financials involved, and they're only going to go up to a certain LTV if they think that the deal is a thin deal, if they think that it's not a very good deal. So if you turn back the clock even just a few years, most GPs were getting 70, 75, 80% LTV on most of their deals most of the time. And then one day they're like, to be safe, we're going to only do 60% leverage on this deal. No. That is
the bank saying we don't want your deal.
Complete bullshit. Like the bank is saying, this is a thin deal. You are overpaying for this deal. The way the bank underwrites is they say, here's our maximum loan proceeds based on how much we think the asset is worth. And then if you are willing to pay, $10 million more than we think the asset is worth, that's okay, but you have to come up with the cash. That's how every lender does it. And then sometimes GPs will go get mezzanine debt and pref equity and all these things to stack up that sound sophisticated, but mezzanine debt and pref equity are extraordinarily expensive. And you would never, ever, ever use those instruments unless you were just desperate to get to a higher LTV, because you couldn't get those loan proceeds from your first lender because they thought the deal was too thin. That's the reality situation. So if a GP tells you, oh, we have a really safe, deep capital stack, that's just sophisticated terminology bullshit. So when we get 80%, 90% LTV deals, that means we're getting really good deals. That means the bank is looking at it and they're going, holy buckets, there is so much opportunity, so much upside potential. And even if things don't get that much better, the deal as is so darn good that we're willing to underwrite a huge amount of debt on this asset. And I'll conclude by saying that the idea that low LTV debt is safer than high LTV debt is utterly insane. Like it makes intuitive sense. Like it seems right that a lower LTV loan is safer.
Oh, I don't think it makes sense at all.
Well, sure, but you and I talk to each other all the time.
Well, okay. So the worst thing happens.
Yeah. So think about the worst thing.
And this is before your cash out refi. So you have some money in the deal. Let's say it's a $100,000 house, and you have $20,000 in the deal, and you lose it all. Well, you've lost the house and $20,000. That's pretty bad. But if you have low leverage and it's a $100,000 house and you're at 60% LTV and you have 40% or $40,000 cash in the deal and you lose it all, well, you just lost double your money. You still have the same like bad check mark on your credit. Like there's nowhere on your credit that it's like you had a foreclosure for this amount versus this amount. Like you just had a foreclosure and that's really bad. I don't want to lose anybody's money, but if I'm going to lose somebody's money, I want to lose the bank's money.
That's right.
Like to me, that is very intuitive.
And I'd rather lose $20,000 than lose $50,000. And here's the craziest thing of all. So Elaine and I, we call banks all the time and we say, hey, do you have any bad debt on your books that you'd like to get rid of? We're the turnaround experts. Like, what can we do to help you and create this win-win deal, which really optimally positions us when we go ask them for debt on, one of those value add deals that we find. But we get deals that way. And banks don't like to repossess populated apartment buildings. And the higher the leverage on the apartment building or single family home, the lower likelihood that they're going to repossess it, because the fundamental risk calculation the bank does, they do not care about your money.
They don't want to lose their money either.
They don't want to lose their money. So if you're at a 50% LTV, the bank's going to say, well, in a worst case scenario, could it really lose half of its value? Let's roll the dice. Let's foreclose. Let's turn the screws on them, push them to surrender the asset, do a deed in lieu of foreclosure. But if they're at an 80% LTV, the bank says, well, shoot, if we foreclose on this thing, there's no way it's not losing at least 20% of its value. And if the person we're foreclosing on really makes it tough for us, it could lose 30 or 40% of its value. We're going to lose our shirts. We better not foreclose. And so I have seen assets where the owner has been in non-payment for years and the lender doesn't foreclose. And when I say, why the heck haven't you foreclosed on them? They say, because they owe us too much money. It's that old, adage that if you owe someone a little bit of money, you have a problem. If you owe someone a lot of money, they have a problem. And that's exactly how it works. So you want to have as much leverage as you can possibly
assuming
have.
it cash flows. It
Assuming
must
cash
cash
flows, yep.
flow. It must
Yep.
cash flow. And it must
And,
cash
and
flow.
have cash reserves.
Yes, you have to have a ton of cash reserves. It must
Yeah.
like there are things that are just like very intuitive to us that make our business model safer.
Mhm.
And it's important that we mention those things
Yes.
so that you don't hear go get as much leverage as possible, but miss the cash flow piece or miss the cash reserves piece or miss the fixed interest rate piece. And again, all of this is just what we're doing. This isn't investment advice,
Yep.
But the pieces all link together. Just like the question from Derek about, well, why were you saying to buy in February 2022 when rates were low? Well, because the pieces all link together with rates, inventory, what renters are willing to pay for rent, where rent growth was going, the monetary supply that was coming in.
And we said, be cautious and make sure the numbers work and do what it takes to win the deal, but don't overpay. So that was our explicit guidance there, because we think now is always a good time to buy, but it's certainly much easier to get a good deal in a period of rising interest rates and lowering asset values than the reverse. So that's our soapbox about leverage. Excellent question, Mark. You always have such excellent questions. We really appreciate that. We're very opinionated about that topic because we have seen more than enough data to, I think, have a kind of a reasonable kind of conclusion on that. But we're always open to additional ideas on the topic. And
Absolutely.
We'd always love to hear more.
Absolutely.
Yeah.
Wonderful questions here at the end. Thank you so much. We would love it if you gave your feedback. It's a quick Google form. Rachel will pop it into the chat here. It's very brief. It will take no more than 90 seconds, maybe 60 if you read quickly. That would mean so much to us, particularly on a night like tonight where we diverted our content, moved to something very in the moment. It would be helpful to hear feedback.
Was it valuable for us to do this kind of, contemporaneous content, so to speak? Whenever we get a bunch of questions all at once from people, unprompted, we know that this is probably a burning question on a lot of people's minds, but we want to know, did we kind of hit what is this bringing you the most amount of value? What could we have done to bring you more value? We hope after tonight, you look at the front page of the newspaper and say, yeah, of course. Like I can see that in the context of the seasons in the cycle. And I didn't know it was going to be that company or that industry, but we're in January. It's freezing cold outside. Of course, there's going to be some casualties. It gives you some peace and some calm and some clarity about what comes next, as well as some immediate action items you can take to enjoy the rest of this lovely winter.
Yep, absolutely. So Rachel just put the feedback form there in the chat. So if you're grab your phone, grab your computer before we end the call and get the feedback form. There's also our events calendar. Thank you so much, especially you diehards that stay all the way till the end. We love you guys. We love everyone, but we particularly love you crazies that stay with us all the way till the end. It's always a pleasure to chat with you. It's always a pleasure to serve you. We get so much joy out of having the opportunity to take all of this information and what we're seeing and kind of synthesize it and share it with you. We spend a lot of time. I think we project a lot of, certainty and confidence when we're on the camera. We spend a lot of time just really making sure we're stewarding our investors' capital well. I wouldn't say it keeps us up at night, because we really do believe our business model is very safe, very conservative, but it's something we're always thinking about. We're always, every day we're asking ourselves.
We talk about it before we go to bed, before we fall asleep.
Oh,
that doesn't keep us up at night, but we think about it right before we fall asleep.
Yeah, we're just, did we make wise decisions today? Are we going to make wise decisions tomorrow? What do we need to know? Who do we need to know? And just love the opportunity to not only steward your cash that's in our assets, that's in our bank accounts, but share our knowledge with you as well. So thank you so much, everyone. We will see you all next month for Passive Investing 201. In the meantime, our Facebook group, other ways, block a time on our calendar. We're super available to all of you. We care about you all a great deal. Have a great night.